Thanks for joining the webinar today. Just a little bit about myself. As Chris says, I'm the VAT manager at Scrutton Bland. I've been here just over a year, but my VAT work experience goes back more than 25 years, mainly in finance in London. So really, since joining Scrutton Bland, my VAT knowledge has increased dramatically as a result of dealing with all sorts of businesses from all walks of life. So hope you enjoyed the seminar today. This is, like Chris says, just covering the basics as a start off, and then we'll go more into detail about place of supply rules and reverse charge VAT. So just some basics to start off with. So what is VAT? It's an indirect tax where the consumer ultimately bears the cost. It was introduced into the UK on the 1st of April 1973, and the legislation is covered by the VAT Act of 1994, but also there are more detailed rules in various statutory instruments and VAT notices which are issued by HMRC on a regular basis. Good bedtime reading, if you're interested, is VAT Notice 700, which is the VAT Guide. I think there's 182 pages. So if that doesn't guarantee you a good night's sleep, I don't know what does. So what does VAT apply to? It applies to business transactions involving supplies of goods or services where the place of the supplier is the UK and it is made by a taxable person in the course of their business. A taxable person is a business who makes taxable supplies and is required to be VAT registered. A taxable person can register voluntarily, but must register if their VAT threshold exceeds £90,000, which is the current VAT threshold. It's quite common for startups to voluntarily register in order to recover any VAT they suffer on their startup costs. So VAT applies to taxable supplies, which is defined as any supply which is not exempt from VAT. In the UK, we have three rates of taxable supply. We have the standard rate at 20%. Examples of this are professional services, new cars, lots of types of food, private school education, and so forth. Then we have the reduced rate of VAT at 5%. Examples of this are domestic or charity non-business use of fuel and power. Perhaps an unusual one is conversion of a residential building to a charitable use building. So, for example, converting a house into a care home. And then we also have the zero rate of VAT, which is a taxable supply, but at a zero rate. And examples of that are books, new houses, things like bus and train tickets, exporting of goods from the UK, and most agricultural products. So coming to the VAT thresholds, I mentioned earlier that you must register for VAT if your business has total taxable turnover for the last 12 months exceeding £90,000, or you're expected to exceed £90,000 in the next 30 days. For businesses located outside the UK making taxable supplies to the UK, there is a nil VAT threshold. These businesses are what is known as NETPs, or non-established taxable persons. As I mentioned earlier, if taxable turnover is greater than £90,000, you can register voluntarily. If you only make exempt supplies, you cannot register. Taxable turnover is the total value of supplies except VAT exempt or outside the scope of VAT supplies, and it is calculated on a rolling 12-month basis. So it does include zero rated supplies, reduced rated supplies, and standard rated supplies, obviously, as well as other things which I'll come to later in the webinar. So if your business does exceed the VAT threshold of £90,000 over the last 12 months on a rolling basis, you must register with HMRC within 30 days of the end of the month the threshold exceeded. The effective date of registration is the first date of the day of the second month after exceeding the threshold. If you also expect to exceed the £90,000 threshold in the next 30 days, then you must register by the end of that 30 days, and your effective date of registration is the date when you realise you would be going over the threshold. If registering late, you must pay VAT on any sales made since the date you should have been registered, and penalties may also apply. So it's unwise to do that, and we do recommend that all new businesses do keep a rolling 12-month taxable turnover calculation. If you exceed the threshold temporarily, you can apply for what we call an exception for registration. That would apply to seasonal companies, people that sell lots of things during the summer and maybe it goes quiet during the winter. So they're in and out of the threshold, basically. In that case, you can apply for an exception. If mainly zero-rated supplies, you can apply for an exemption from registration as well. And if you are a non-established taxable person with all zero-rated supplies, then you can also apply for that exemption. The deregistration threshold is £88,000, but that's not applicable for the NETPs, as we said earlier. And VAT registration must be cancelled if at any time you stop trading, you no longer make taxable supplies, or you join a VAT group. So just to cover some common VAT terminology, first one we have is output tax, and that's the term for VAT charged on sales. And then you have input tax, which is the VAT suffered on your purchases. And output tax less the input tax on your VAT return results in the VAT payable or repayable to or from customs, HMRC. So a fully taxable business is one that only makes taxable supplies, but it could be a mixture of standard, reduced rated and zero rated supplies, because they are all, as I said earlier, taxable supplies. An exempt business is one that only makes exempt supplies and therefore cannot register for VAT. A partially exempt business, however, is one which makes a mixture of both taxable and exempt supplies. So a repayment trader is a trader or a taxable person where their input tax is usually higher than their output tax, and therefore when submitting their VAT returns, they are claiming repayments of VAT from HMRC. A common example of this is a farmer who quite often makes zero-rated supplies, but they obviously incur input tax on their purchases, so they are commonly a repayment trader. VAT fractions, this is where we use, these are what we use to calculate the VAT from a VAT inclusive price. So the fraction for standard rated items is 20 divided by 120 or 1/6, and for reduced rated items is 5 divided by 105 or 1/21. And I just referred previously to VAT groups. This is where two or more eligible persons can be treated as a single taxable person for VAT purposes. Only one VAT return is submitted to HMRC for the whole group. Going on to VAT compliance, VAT returns must be prepared and submitted to HMRC to cover what is known as a tax period. The standard tax period is 3 months, ending on the last days of either Group 1, Group 2 or Group 3, which cover the 12 months of the year. Most common is obviously the one that goes in line with the calendar quarters, Group 1. So HMRC allocate these upon registration, a group, but it can be changed to fit in with the financial year of the business through the business's online VAT account. You can also request to submit VAT returns on a monthly basis, and this is ideal for those companies that are repayment traders, i.e. their inputs are more than their outputs. And the deadline for submission of all VAT returns is 1 month and 7 days after the tax period end. There are also several schemes. There's an annual accounting scheme available for businesses with taxable turnover of 1.35 million or less. So therefore, this consists of advanced monthly, quarterly payments based on estimated liabilities, and then one VAT return with a final payment. There's also a flat rate scheme, which is available for businesses with taxable turnover £150,000 or less. And there are various flat rates which apply to the business types. Obviously, if you do not submit your VAT returns on time, or you are late paying your VAT liability, there are penalties applicable. So coming to the VAT return, this consists of 9 boxes. So just go through quickly what these are. So in box 1 of your VAT return, this is the VAT due in the period on sales and other outputs. So i.e. it's the output tax for the tax period, whether it's a quarter or a month or a year. Box 2 is VAT due in the period on acquisition of goods into Northern Ireland from the EU member states. This is what's changed since Brexit, basically, and only now applies to Northern Ireland. Box 3 is your total VAT due, so it's box 1 plus box 2, so that's your total output tax. Box 4 is your VAT reclaimed in the period on purchases and other inputs, and includes acquisitions of goods into the Northern Ireland from the EU member states, so that is your input tax for the tax period. Box 5 is the net VAT payable, repayable to or from HMRC. Box 6 is the total value of your sales, excluding VAT and all other outputs. And box 7 is total value of all your purchases and all other inputs, excluding VAT. Box 8 only applies to Northern Ireland, which is the total value of all their supplies and related costs, excluding VAT from Northern Ireland to the EU member states. And box 9 is applicable to Northern Ireland also, which is the total value of all acquisitions of goods and related costs, excluding VAT. Going on to the place of supply rules. So for UK VAT to apply, a supply must be made in the UK. Supplies made outside the UK are outside the scope of UK VAT. So looking at goods, place of supply of goods, you'll see in the sections that I've put where the place of supply would be. So if the goods are in the UK when supplied, the place of supply is the UK. Goods outside the UK when supplied, outside the UK. Goods installed or assembled outside the UK are outside the UK. And then goods supplied from Northern Ireland to the EU under distance selling rules, which are under the threshold of distance selling rules, which is €10,000. That would be the UK. And last, goods supplied from Northern Ireland to EU under the distance selling rules, which are over the threshold, would be the EU member state where the goods were delivered to. So going on to place of supply of services, we split these into 2 general rules. We have one for B2B supplies, business to business supplies. And the general rule in relation to these supplies is where the customer belongs. The place of supply is where the customer belongs. In relation to business to customer supplies, such as private individuals, the general rule is a place of supply is where the supplier belongs. We also have some special rules. So we have land-related services, and the place of supply is where the land is located. So, for example, hotel accommodation, maintenance or repair of a building, which is the place of supply would be where that building is located. We've got a problem with our slide pack here, so we have amended the slides here, but there's another special rule relates to hire of means of a transport, so that should be bold here. And so for short-term hire of transport, B2B and B2C, place of supplies where the vehicle is put at the disposal of the customer. Long-term hire, B2B, follows the general rule, and long-term hire, B2C, is place of supplies where the customer belongs. And there's also a special rule in relation to services supplied where performed, such as admission to an event, the place of supply is where an event takes place, and catering services, the place of supply is where the services are carried out. There's also a special rule for B2C services of professional, technical, financial, intellectual, or other intangible nature, which are supplied to customers outside the UK. The place of supply then is where the customer belongs, therefore it's outside the scope of UK VAT. That goes against the general rule, which would usually dictate it's where the supplier is located. So, for example, tax advice given by us, Scrutton Bland, to a resident that's located in France, that would be outside the scope of UK VAT. We would not put UK VAT on our invoice to that individual. We also have use and enjoyment rules, which are in place to ensure that the place of supply for VAT is where the services are consumed. These rules will apply where the place of supply under normal rules would be the UK, but services used and enjoyed outside the UK, or outside the UK, but the services used and enjoyed in the UK. The place of supply is where the use and enjoyment takes place. So it covers such things as letting on hire of goods, including means of transport, is where the goods are used. Business to business electronically supplied services, for example, where a business is when purchasing information over the internet, or B2B telecommunication services, where a business is when making a telephone call. Now coming on to the reverse charge, which is an anti-avoidance concept that's been around for quite a few years now. And a supply is subject to reverse charge on almost all B2B suppliers of services where the place of supply is found to be the UK, the supplier is not in the UK, the recipient of the supply is in the UK, and the supply is not exempt or would not be exempt if it was made in the UK. So when all of the above is applicable, the recipient of the supply must act as if they are both the supplier and the recipient of the service. And therefore they have to include in the VAT return both output tax and input tax in relation to that supply. So just to highlight this, we are going through a few examples. So in example 1, we have a fully taxable, so i.e. they only make taxable supplies, UK business, which receives advice from a French lawyer, and the French lawyer invoices the business €1,000, the exchange rate of 0.85. So the French lawyer is obviously not registered for UK VAT, so he wouldn't put UK VAT on his invoice. The place of supply for this B2B supply is where the recipient is located. So the place of supply is the UK. So the recipient of the supply has to put in box 1 of his VAT return the output tax in relation to that invoice, which would be €1,000, 20% standard rate, divided by the exchange rate, which would give £170 output tax. On the other side, it's also treated as a purchase, so the input tax would be exactly the same amount because he is a fully taxable UK business. So it nets out as nil, so there's nothing payable or repayable to or from HMRC. In box 6 of the VAT return, they would put the net amount of the supply, which would be £850, in sterling, and total purchases, excluding VAT, would also be £850. So as I previously stated, as the business is fully taxable, it only makes taxable supplies. There is a nil net effect. However, what causes complications is in relation to partially exempt businesses. So in this example, we're using a partially exempt UK business, which has a recovery rate of 50%. So he makes a mixture of taxable and exempt supplies, with the taxable element being 50%. The business also receives legal advice from a French lawyer and an invoice for €1,000. So in this case, the output tax would be exactly the same as before, 20% of euros converted to sterling, £170. But because he can only recover 50% in the input tax, that would be 50% of the £170, which is £85. So in this example, he would need to pay to HMRC £85. Box 6 and box 7 remain the same. So there's a net cost to the business of £85 in this situation. Right, okay, so now I need to move over. We're going to ask for questions and answers to be posted onto the site. But we thought what would be a good idea, and perhaps a little bit of fun, hopefully you can refer to your notes to have a quiz. So let me see if I can move over to that. Okay, so I think we have 12 questions for you. Hopefully you can scan in the QR code so you can join at slido.com. So it'd be interesting to see what answers people have for the questions that we're setting out in a few seconds. I want you to give this some thought. It may throw you a little bit, but we can all go through together. So out of the following series of questions, I'd like you to consider whether you consider them taxable or exempt or outside the scope of VAT supplies. And if taxable, at what rate do you think that should be charged? There may also be a few reverse charge items here as well, so just to make you aware. So coming up with the first one. Interest charged on a business loan. Okay, I think everyone's got that right. So yes, that would be an exempt supply for VAT purposes. On to the next one. Bottle of mineral water sold by a supermarket. Okay. Yep, everyone I think is correct on that. Sounds standard rated, which seems crazy, doesn't it? That you have to pay 20% VAT on a bottle of water, but there you go. Third one, pint of milk sold by a supermarket. Well done, everyone. Yep, zero rate. Basic foodstuffs are zero rated. There's lots of VAT cases around in relation to food types and foodstuffs and things like that, but milk, luckily, is still zero rated. On to the next one, sale of a train ticket for business travel. Yep, majority of people got that right. It does confuse people. It is zero rated train travel. Right, legal fee invoice from a UK law firm to a UK business. Well done, everyone. Yep, standard rated. That's quite straightforward, that one. See how you get on with this one. Legal fee invoice from a German law firm to a UK business. Well done. Yep, reverse charge applies to this one. So the German law firm wouldn't be UK VAT registered, so they wouldn't put German VAT on it because places supply to the UK. Therefore, the UK business would need to apply output tax and input tax on that supply. Tax advice, invoice to a non-UK client from a UK accountancy practice. Okay, got a mixture of suppliers replies there. So I was meaning this to be a private individual, so perhaps I didn't make that very clear there. If it was a business, then it would be subject to reverse charge in that client's country if they are an EU member state. However, I meant this as a private individual based outside the UK, and in that case, it would be outside the scope of UK VAT, and no VAT would be chargeable at all, which seems a bit to me to be a bit weird. But it is the law, unfortunately. So the non-UK client doesn't have to pay either. For example, he's based in France, he doesn't have to pay French VAT or UK VAT at all. Sale of a new residential dwelling. Okay, that's interesting. Sale of a new residential dwelling is zero rated. So, God, I'd hate to think what it'd be like if it was standard rate and we had to pay VAT on our houses. But what I would point out is once the dwelling is then sold on, and it's exempt supply. So the first sale of a new residential dwelling is 0 rated, and then it's exempt following that. Labour costs charged for converting a residential dwelling to a care home. Okay, well done to those that said reduce rated or 5%. That is the case for this. There are quite a few complicated rules in relation to construction, which I won't go into in this webinar, but the labour costs and the building materials, applicable building materials, should I say, qualifying building materials, would all be at reduced rate in that case. Well, I've got 3 more left. So we've got an admission fee charged to attend a conference being held in Paris. Okay, so yeah, this one is outside the scope of UK VAT. The place of supply is where performed. It's one of those special rules. So French VAT would be charged by the event organiser. Last but not, actually no, it's second to last, accommodation fee charged by a hotel in Rome. Well done, everyone. Yeah, outside the scope of UK VAT, place of supply is where the land is located, if you remember back to the special rules that we went through. So Italian VAT obviously would be charged in that case. And this last one, short-term car hire charged during business trip to Spain. Outside the scope of UK VAT is this one, place of supply is where it's put at the disposal of the customer. So in this case, it would be Spain.
And if that's it, I'd just like to say thank you for joining, and look forward to seeing you on the 10th of July.
Thank you very much.
Thank you, Chris and Paula. Thank you for everyone for joining.
For joining the Understanding Principles of